You are being played. Every day in the crypto markets, there are numerous forces at work to manipulate the markets and steal those hard-earned sats. This can be incredibly frustrating for most of those traders who are just trying to break into the market. It's tough enough as it is to manage crypto market risk, so adding an additional layer of risk from manipulation just ain't that fair. So, how do you avoid this then? Well, by knowing how to spot it. My name is Guy, and in this video I'm going to be taking a look at some of the most pervasive crypto market manipulation. I'll also give you some top tips that could help you sidestep those hidden landmines. So be sure to watch till the very end. Quickly, a few disclaimers. Of course, this is not investment advice, so please consult your financial advisor. Always do your own research and be aware of the risks. Also, if you're new here, it's great having you. I highly suggest that you hit up that subscribe button and ping that little bell. I do these regularly, so you'll want to get them while they're hot. Right, let's get back to market manipulation. Now, before I get into the nitty-gritty of nefarious tactics, I wanted to give you a bit of an overview on market manipulation. It's not something that is exclusive to the crypto markets. Some of these have been used in traditional finance markets for a number of years. The only difference is that many of these tactics have been outlawed by the SEC. They have developed monitoring and reporting procedures which make these tactics incredibly risky for those who perpetrate them. In most developed markets, the participants can pretty quickly be identified and prosecuted. The same cannot be said about the crypto markets. Unregulated and mostly anonymous, those with large holdings can act with impunity and profitability. You don't know who is behind large sale pressure on a crypto coin or token. You can't identify who built up that order wall you see on the exchange. Essentially, it can be a murky old mess. Is this a massive problem? Well, yes and no. Crypto is about financial freedom, freed from the strictures of traditional finance. It's an opportunity for users to take individual responsibility for their finances. This means that they also have to manage the risks on their own. Anyways, with that out of the way, let's take a look at how you manage these risks. The first and perhaps most pervasive manipulation tactic used in the crypto markets is the pump and dump. Most may have heard of it, but for those that haven't, the impact can be severe. So, what is it exactly? Well, the name says it all, really. Insiders or other market participants will try to pump the value of a coin until it starts gaining attention. Once other unwitting traders start jumping into the markets, then the group dumps the coin on them at a handy profit. These used to be used on penny stocks back in the day, but low liquidity altcoins have become a fertile breeding ground. You don't need a lot of crypto in order to pump these low-cap shitcoins. Moreover, a lot of these pump and dump operations are well coordinated. Users band together in Telegram groups and brazenly perpetrate these actions. Some of these groups and channels have pretty obvious names like McAfee Pump and Rocket Pump. Some of these groups have tens of thousands of participants. Indeed, it's worth pointing out that many of those who could get burned by a pump and dump are those that are late to the pump. Kind of like a game of crypto chicken. Those who wait too late to dump their coins are left holding a bag. And it's not just the pump groups. Even exchanges have gotten in the action in the past. Here is a post by the Yobit exchange back in the day. Pretty scammy if you ask me. Pump and dumps in crypto have attracted a hell of a lot of attention and have even been the focus of academic studies. For example, in this paper, 2 researchers from Imperial College London used machine learning algorithms to see whether they could identify a pump and dump scheme. Pretty cool. I've actually linked to this below if you want to read. Now, anyways, how do you spot a pump and dump? Well, there isn't a single data point that you can look at to identify these things, although there are a number of factors that will add to the likelihood that something is a pump and dump. Firstly, these tend to happen in low market cap coins, most definitely out of the top 100 coins and most likely below the top 200. Sure, pump and dumps do happen with high cap altcoins, but they are the exception, not the norm. In the case of the research piece I mentioned, they stated that half of the pumps took place on coins that had less than 100 Bitcoin, which is a pretty low cap coin. Another thing to consider is where the coin is listed. Generally, pump and dumpers will choose those coins in which there are limited listings, preferably only one listing. This will allow them to have a greater impact on the price on CoinMarketCap. It will also mean that potential victims will have to come and buy the coins from them on the only exchange they can. Pump and dump schemes may happen on a particular exchange even if it is listed on more than one. In this case, you can view it with suspicion if there is a lot of price and volume movement on only one exchange. This could be an indication that it's a coordinated action and not general market sentiment. And speaking of volume, this is another really important indicator that you can use pre-pump to help you determine whether there could be manipulation. Remember that the pump and dump operators are looking to profit from it, so they likely accumulated a lot of coins beforehand. If there is a lot of volume that seems to have come out of nowhere prior to a price increase, then it could be an admin accumulating the coins. Finally, perhaps the last and most important indicator that a pump and dump is going is, of course, the price. That is, after all, the target of these groups, to dupe people into buying them by giving them some serious FOMO. So if you can't really understand why a coin is pumping, then don't just buy it. And if you're one of those who are trying to catch a pump scheme to profit, shame on you. Just remember, a dump often also harms those who think they can profit from it. Anyways, let's move on to the next manipulation tactic, shall we? Hi guys, it's Guy the Crypto Guy with a special public service announcement. I just want to wish all of you guys well. I know that the coronavirus has blindsided all of us, hell, the entire world. The crypto markets are tough, but traditional markets are not faring any better. But then again, money is a material thing that can be made or lost. Our health, not so much. So please keep safe. Practice social distancing, take heed of the restrictions imposed wherever you are, and avoid the temptation to hoard toilet paper. I'll still be bringing you the content you love despite the turmoil outside these walls. We will get through this. Let's flatten this COVID curve and then moon that Bitcoin price. Back to the video. Order book spoofing is a crypto whale's forte. It's one of those gets 'em every time moves. So what is it exactly? Well, it's basically a tactic where a market participant will place a large set of orders with no intention of ever having them executed. The market participant is trying to create the illusion of large demand or supply in the market even if there is none. It's also sometimes termed painting the tapes. This manipulation tactic has been used in the commodities markets for a number of years. In fact, a pretty recent example is our friends over at JP Morgan, who are facing a criminal probe in relation to their spoofing in the metal markets. Oh, and a fun fact, Jamie Dimon, the JP Morgan CEO, has called Bitcoin a fraud on a number of occasions. Anywho, this is a tactic that has been well adopted by the large crypto whales in the ecosystem. The practice was particularly rife during the 2017 bull run as Bitcoin prices surged to record highs. The crux of the strategy is to basically build up a large buy or sell wall on the order books of the exchange. When market participants see these order walls, they're likely to react to them. I mean, if you see a sell wall of over 1,000 Bitcoin on an order book, that's likely to spoof your analysis. Are you likely to buy Bitcoin if you think that it won't break past a sell wall? Probably not. However, in the background, the whale is secretly accumulating Bitcoin while the market hits those sell orders. Then, as if it came out of nowhere, you'll see that the sell wall evaporates into thin air. The whale then pulls his order knowing that his deed is done and the market has been fooled. This can of course happen on the other side of the trade as they build up those large buy walls. You think that there is support to hold up selling pressure. This creates some bullish sentiment among the rest of the market participants. You go long on Bitcoin expecting that the bulls have the edge until you realize that those bulls were nothing but wolves in bulls' clothing. And the opportunity to profit from spoofing becomes that much more lucrative when these same whales take positions in the Bitcoin futures market. They can profit from volatility in a derivative market where they are manipulating the price discovery in the underlying market itself. It really is a fascinating tactic, devious but fascinating. If you want to learn more about crypto market spoofing, how it forms and how to spot it, I encourage you to read our post on the topic, which I have linked to below. Anyways, the next market tactic that I want to look at is a variant of spoofing, and it's called wash trading. Wash trading is a tactic that's used in order to create the perception of an active market in a particular asset. Like the other tactics mentioned above, it's illegal in established financial markets but appears to be fair game in the crypto space. It usually entails the simultaneous buying and selling of the same asset by one individual or between a group of individuals. The hope is that it creates an illusion of volume in the asset itself. In general, traders are more likely to trade a cryptocurrency that has more volume and hence liquidity than those that do not. Of course, this volume is nothing but a facade, and those traders will soon discover that the underlying liquidity is not there. Those who take part in the wash trading are usually either specific crypto projects or those backing it, as well as the exchanges themselves. This was actually brought to light last year with this article about this one Russian coder who will develop bots to fake exchange volume. This is all done in order to pump the volume numbers on CoinMarketCap. This dupes the newbies into thinking other people are trading said coin or using said exchange. And this is actually a pretty important point that has been raised on countless occasions. Those volume numbers that you see on CoinMarketCap are not as they appear. There was actually a pretty interesting presentation by Bitwise Asset Management at an SEC hearing last year. In it, they claim that over 95% of the volume is, quote, fake or non-economic in nature. Pretty damning, to be honest. Although CMC have been making a concerted effort to improve their filters of late. So how do you spot a wash trading on an exchange? Well, perhaps your first bet is to avoid dodgy exchanges. There is now such a large selection of reputable exchanges that should have the coins you want to trade. There's no need for you to use some bucket shop operator out of God knows what offshore location. You can also then look at the order books of suspicious exchanges in order to spot the faking. The telltale signs of faking are an almost uniform pattern of buy-sell orders. You'll also notice that on every timestamp you have a matching pair of buys and sells. These trades will also be roughly equal in size so that both the buy and sell match. Then when it comes to the order sizes in general, they're quite random and have never less than a certain threshold. Finally, if there is a pretty large bid-ask spread on an exchange that is supposed to have high liquidity, it's usually something you should be cautious of. Also, sometimes these things come down to a bit of gut feeling. Should some obscure, unheard of exchange really be doing almost as much volume as Coinbase Pro? It also helps to do your own research. Tap the community to ask their opinions about particular exchanges. There are some that are known to be unreliable at best and complete scams at worst. Anyways, if you want to read more about crypto faking, I have a post on that below. Moving on though, let's take a look at the next nefarious tactic on our list. Sometimes crypto whales just like to go hunting for all of those stops. Stop-loss hunting is a tactic that used to force market participants out of their positions by driving the price of an asset low enough so that it triggers their stops. The hope of the whale that is using this tactic is that they will be able to pick up the asset at a lower price. It's just using your significant market clout in order to force the hand of other participants. Also, most traders will tend to place their stops at key technical levels. Absent of any market manipulation, these levels generally tend to signify key capitulation points. So, the whales have an idea of where to target when they're pushing the market down. Let's take a look at an example, shall we? Here is some unidentified altcoin on Bitfinex. Let's call it Minnow, MNN. The green line is where the stops are positioned. Whales love minnows and want to stock up on MNN. They execute a whole host of sell orders and push the price towards the stops. Once it reaches key technical levels, a host of automated sell orders hit the market and the whale can scoop up his MNN. As you can see, the market recovers almost immediately as the whale buys the MNN and other market participants realize that it's going on the cheap. You, on the other hand, wake up to discover that your stops were hit overnight and the price is where it was just before you went to bed. Okay, so how do you avoid being the prey in this hunt? Well, this one is a bit trickier. You still want to be placing those stops, as these are essential to manage risk. More likely than not, the market is legitimately moving down and you'll want to protect your downside risk. However, what you could try and do is place a stop limit order. These are basically stop orders that will have an execution price above the trigger price. So once the market goes through your stop, limit sell orders will be placed a few points below the stop level. The benefit of this is that you're still protecting yourself from large downside risk. However, you are leaving a bit of room to confirm that it is indeed a legitimate capitulation point. There are a number of exchanges that offer variants of stop limit orders. If you're trading futures, then Bybit has what they call conditional orders. Anyways, stop hunting is a really intriguing market tactic that I could talk about all day long. We don't have the time here, but if you want more info, yes, that's right, we have a post for that. The final market manipulation tactic that I want to look at is FUD. Yes, that's right, FUD. Fear, uncertainty, and doubt is often one of the most effective ways to move a crypto asset's price without actually buying or selling anything. Crypto traders can be pretty jaded and negative news sends them for the hills. It's actually a well-known psychological heuristic that human beings have a strong aversion to loss. In fact, they feel more upset by taking a loss on the downside than they feel good about taking an upside profit. I guess all I'm trying to say is traders hate taking losses. Hence, if you create a fake news narrative around a project of some sort, then you can have a pretty large impact on the price. Sell the rumor and buy the news, so to speak. Propagating false information is used with great effect by many long-short equity hedge funds. They will usually push false information about a company just after they've taken a sizable position on it. Now, out of all the other tactics, spotting fake news in crypto can be quite a difficult endeavor. The whole crypto news space is filled with so much junk that it's really hard to filter. A lot of it will have to come down to your own judgment. Is the source reputable? Are there facts to back up the claims? Is it being pushed by known trolls in the space? Could said trolls have an ulterior motive for spreading the FUD? Also, you don't want to fall into the category of person who dismisses everything as FUD. Sometimes concerns are legitimate and they will likely manifest themselves in a useless project. Let's not forget that many of BitConnect shills were at some point shouting FUD. And that's it, my list of some of the top manipulation tactics to avoid. I hope I haven't deterred you too much from trading in these Wild West markets. The truth is that they are becoming much less lawless these days. Most of the reputable crypto exchanges won't allow some of these tactics on their platforms. Moreover, even though there's no crypto trading regulator, the CFTC and SEC have taken notice. Both have either issued consumer advisories or pursued legal cases against miscreants. In any event, it's important that you're aware of these tactics so that you can avoid these potholes. And I hope that this video has aided that in some way. Now, I've done a lot of talking. Have you guys got any questions or comments? I'd love to hear from you below. Also, if you found this video helpful, then please hit up that like button and don't forget to subscribe. Much more is just around the corner. Hi chaps, glad that you made it to the end of that video. Now that you're here, I have something interesting to share. Have you heard of my weekly email? Basically, it's my personal take on the crypto markets. Everything from hot projects to hot coins. Unique insights on market movements as well as some news that may have dropped off your radar. Sound appealing? Well then, I'm inviting you to sign up. All you need to do is fire over your email in the form that I've linked to in the description. You may just catch my next newsletter, which you definitely won't want to miss.